Hey folks, today we have got some super exciting stuff to chat about. We are talking about a golden chance to make serious money. You see, sometimes when things aren't going so great in the economy, that's when opportunities to grow your wealth are at their juiciest. And guess what? We are heading into one of those times. It's like a financial roller coaster ride. Now I get it. The word recession sounds scary, but here's the scoop. These economic ups and downs are like a natural part of life. And if you play your cards right, you can set yourself up for an awesome future filled with discounts and opportunities. Even Warren Buffett, the legendary money guru, once said, "Bad news is an investor's best friend." So, today we are going to break down what's on the horizon for the next year or two, the incredible perks up for grabs today, and how you can make some serious dough. Stick around because this video is your golden ticket to financial success. Okay, let's break a few things down before we dive into the exciting opportunities. First, we've got to get a handle on what a recession is all about. So picture this. In a recession, things can get a bit rocky. You've got more people out of work, wages taking a hit, folks feeling a bit unsure about spending money, and the prices of stuff like stocks, groceries, gas, and services are taking a dip. And sometimes, this can have a ripple effect around the globe, sticking around for a while. It's like a financial roller coaster with its ups and downs. Now here's the deal. When a recession hits, companies often see a drop in their earnings. You know those fancy financial reports they put out every few months? Well, recently, a lot of these companies have been saying, hey, our earnings might not be looking so great in the future. In fact, they are getting a bit cautious, even thinking there might be some negative growth on the horizon. This has set off some recession alarm bells, and these warnings are happening at a pace we haven't seen in a whole decade. So there is some serious stuff going on in the financial world. Now let's talk about another piece of the puzzle: layoffs. See, when people are earning less, they tend to spend less, right? And when companies notice that people aren't buying their stuff as much, they start thinking about how to save some cash. Unfortunately, that often means trimming their workforce, and employees are the first ones to feel the pinch. Now let's get into what this means for you and your investments. We'll kick things off with a look at stocks. Currently, the major US stock market indexes are facing a rough patch, down by 20 to 30%. According to JP Morgan, there could be another 20% drop in the pipeline. Now let's rewind to 1946 for some perspective. On average, during stock market downturns, we are looking at almost a 30% drop. The heavyweight champ was 2009 when the S&P 500 plunged a staggering 57% from its peak. But here's the silver lining. Usually, when everyone is panicking and selling their stocks, that's when things are about to turn around and bounce back up. It's like a rock bottom moment for investors, and that's when you could start to see some recovery. So keep your eyes peeled for those signs. Alright, we are about to dive into the money-making part of it in just a bit. But first, let's talk about something else: real estate. Now the deal with real estate is that it's a bit like a patchwork quilt. Different places have different stories. Some spots might keep on thriving, while others may not be so lucky. When it comes to housing on a national scale, big declines aren't very common. In the last 60 years, there have only been a few instances where prices took a dip of more than 10%. But here's what's buzzing on Wall Street. Most folks are saying that national housing prices could drop about 7%. And if things get really messy, we are talking about a worst-case scenario of a 10 to 15% drop, especially if interest rates start climbing. Now remember, every market is unique. So if you are into real estate, there is a lot to keep your eye on. For those of you with a fixed rate mortgage who plan to stick around in your place for another 5 to 10 years, don't sweat it too much. These housing ups and downs might not shake things up too dramatically for you. But here's the exciting part. For those of you who are looking to invest or buy a house, you might start spotting some sweet deals popping up soon. And we are going to get into that in a bit. However, before we do, we have got to chat about our third topic: cash. Hold on tight, there's more to uncover. So here's the scoop on cash. Up until now, many people believed that holding on to cash was like watching your money slowly vanish due to inflation. But when everything else like stocks and real estate is going down in value, cash can become your safe haven for storing your wealth. Here's a fun fact. As recent as 2018, cash was the superstar of the investment world. If you had just parked your money in a high-yield savings account, you would have outperformed the stock market. Yep, cash had its time to shine. Now, cash is becoming such a crucial part of investment portfolios that even professional fund managers are hoarding more cash than they have in over 20 years. Citigroup even suggests that cash is the only asset you can rely on during a recession. So why are people not taking full advantage of this golden opportunity that's on the horizon? Let me break it down for you. Why this upcoming recession could be a golden ticket like no other. One word: discounts. When a recession hits, everything becomes cheaper. In a recession, prices drop, and that's when the smart money starts shopping. Stocks go on sale, and it's an excellent opportunity to invest for the long term. Another awesome thing about a recession is that there's less competition. When the big dogs are cutting back, playing it safe, and trying to save every penny, it's like they are leaving the stage empty. And this gives a chance to smaller, more gutsy companies. These underdogs get a chance to shine and grab the spotlight. Staying in the game and investing when others are pulling out can lead to great opportunities. Now let's talk about the fourth point, and this one's a real gem. After every bear market, a bull market follows. Here's the lowdown. Historically, whenever we are in a recession, the S&P 500 has taken a hit, with an average drop of about 29% and a median drop of 24%. But here's the kicker. Once those stocks hit rock bottom, the next year, on average, they bounce back by a whopping 40%, and within just 2 years, the market tends to rise by around 58%. What does this mean? Well, investing when things are on the way down can be way more profitable than pulling out and waiting. Plus, here's the big picture. In the long run, the market has always bounced back. Every single time in history, it's come back stronger. So don't lose sight of the big gains that often follow the tough times. It's all about staying the course. Now let's talk about the fifth and final point. And this one's a real game changer. You've got to act before everyone else catches on. You see, it might sound simple to say, I'll just invest when there's a recession. But here's the catch. Recessions are never officially confirmed until way down the road. Take the Great Recession, for example. It started in December of 2007, but wasn't officially declared until December of 2008, just a few months before it ended. And the recession before that kicked off in March of 2001, but they didn't officially label it as a recession until November of that year. The pattern continues with about a 6 to 12 months delay before we even know for sure that we are in a confirmed recession. So the key takeaway here is that by the time the official news hits, the big opportunities might already be slipping through your fingers. To make the most out of these times, you've got to be ahead of the curve. So let's talk about what you can actually do to profit from all this. Scale back your expenses. Keep a close eye on your spending. Cut down on unnecessary expenses and operate lean. While doing this, reinvest as much as possible back into the market. Make a plan for what you would do if your income were to drop by 20 to 50%. Be prepared to take preventive measures to protect yourself in advance. Hold on to some cash. It's great to invest your money, but having some cash on side for peace of mind can be smart. I personally keep around 15 to 20% of my portfolio in cash. It has come in handy for grabbing good deals and providing a safety net. Protect your career. Your job is your best defense against financial turmoil. Losing your job while the market is down can be a real setback. Now is the time to upskill, learn new things, start a side hustle or a passive income stream, and double down on your career to make yourself more resilient. Invest long-term. Stick to your long-term investment plan and keep doing what you have been doing. Dollar cost averaging, which means investing a fixed amount regularly, is a profitable strategy. Stay in the market and keep making smart decisions, even when things get tough. Diversify your investments. If you can't handle a 20% drop without panicking, it might be a sign that you are taking on too much risk. Diversify your portfolio by including different types of assets. For instance, if you are heavily invested in the US tech stocks, consider adding large caps and international stocks to the mix. You might even explore real estate or investments that provide stable returns. The more diverse your portfolio, the more resilient it will be if one or two parts take a hit. With that being said, now is the perfect time to kick it into high gear, put in the extra effort at work, explore side hustles, and soak up as much knowledge as you can. Your hard work today will pay off big time when the market bounces back. It might not be a walk in the park, but those who stick with it will reap the rewards. Thanks for tuning in. If you found these investment tips helpful, subscribe to our channel and feel free to drop a comment below. We'll see you in the next video. Until then, stay wealth wiser.